Welcome back to CEO Money. I'm Michael Yorba, your host. All right, we're talking with Bernard Reisz, ReSure Financial. Bernard, welcome to the show.
Hello, Mike. Hello to all the listeners. Great to be here.
I'm glad you're here. All right, you are the principal of ReSure LLC, a financial professional with credentials and expertise across an array of disciplines. So, and you're also a CPA and chartered public casualty underwriter. So it goes on and on and on with the paragraph or so about your bio. Give us the highlights of who you are, so the audience gets a feel for you, and then let's dive into the benefits of using retirement accounts to invest in alternative assets.
Absolutely. So as a CPA with a background in tax, I've always had a fascination with tax-advantaged vehicles. Within tax planning, there's a lot of nitty-gritty, there's a lot of nuance, and there are a lot of positions that you have to take that have uncertainty surrounding them. Whereas when you use tax-advantaged vehicles, if you do them in a way that's compliant, you get a measure of certainty regarding your tax compliance, your tax reporting, and best of all, you can get tax-free gains within an array of assets. Most recently, that's been most attractive within the cryptocurrency space, but this can be applied to any kind of asset prior to the emergence of crypto. Real estate and real estate-related investments such as mortgage notes, tax liens, and deeds were definitely the most profitable and most attractive investment for retirement accounts. But over the last few months, that has been displaced by Bitcoin and other cryptocurrencies.
Yeah, I mean, there's probably a few people out there quaking in their boots going, wait a minute, whoa, cryptocurrencies in my retirement account, in my 401k. Maybe some private equity because sometimes it's a longer-term play, but the cryptocurrency is generally synonymous with high rates of volatility, and whether it's a pension plan or it's a simple IRA or a 401k, they kind of tend to wait to back out of that or get away from it because of the volatility in it. But you're looking at it from a different light. I want to hear that point of view.
Yeah, absolutely. So the way I see retirement accounts through the lens of the tax code, it's a tax-advantaged vehicle, and it's there to induce you to put aside funds for your future self. Mm-hmm. And any funds that do go in there will be set aside for your future self, your retirement. They will have all the restrictions that retirement plans have. Now, there are two different approaches within retirement accounts. There's generally the Roth approach, and then there's the traditional approach, available within IRAs to the tune of about $6,000 a year, and within 401ks to about $60,000 per year. So the Roth approach, let's just, provide the basics. If somebody bought cryptocurrency when it was, just a few months ago, and certainly a few years ago, and the incredible appreciation that they would see, that would all be completely tax-free. So we're talking about many thousands of percentage points in gain, and that would be completely tax-free. And it brings to mind what was reported during the Romney presidential run, that he has an IRA valued at well over $100 million. So that's definitely doable, and that's one way of approaching it. The other way of looking at it, if it's a volatile asset, you'd like to get into it, but you want to hedge a bit. So if you do it on a pre-tax basis, if it doesn't go in your direction, your investment is actually lower because there's a portion that would have gone to the government anyway. So I just see it as a tax vehicle and a way to get tax certainty, in particular with regard to cryptocurrency, because right now there are just so many questions about the treatment of cryptocurrency gains in light of the incredible gains that traders and those that have held Bitcoin have seen. Now they have incredible taxable gains to recognize, and there's very, very little clear guidance. Within these plans, the tax treatment is clear, and it can all be tax-free or tax-deferred.
Got it. Okay. Who qualifies, and changing tact here for a second, who qualifies for solo 401ks, and how do you qualify for a solo 401k?
So a solo 401k is the 401k that we're all familiar with. 401ks are very, very flexible and provide lots of planning opportunities. But within the scope of a large company, it gets to be cost prohibitive to give you all the flexibility that the tax law allows. However, when you have a small business that only has partners and doesn't have full-time employees other than those partners, they're free of all that compliance reporting related to large 401k plans. So they can have a 401k plan that gives them the ability to employ advanced tax strategies and invest in nearly any asset imaginable. So to answer the question, and in summary, you want some sort of self-employment income and the absence of full-time employees that are not owners of the business.
Okay, got it. Ed, any questions here?
Well, obviously, your last question there, it kind of qualifies the entire process here, is the ability to identify a self-directed IRA custodian that allows these particular types of investments to be there. I get the biggest question comes up when you look at the cryptos is, at what point are they responsible for allowing you to invest in it or not invest in them? And obviously, with self-direction, the assumption is you're taking the risk yourself. So I guess if you were to include those particular type assets into a self-directed IRA, who bears the the suitability part when you actually make those investments?
So there are a couple of different angles on this. So we talk suitability. That's the kind of terminology you'd get with a Series 6 or Series 7 stockbroker, and that's absent here. In all these plans, they're self-directed, so the burden for the investment performance and investment selection is on the plan beneficiary and owner. With a solo 401k, there is no requirement that there be a custodian involved whatsoever. You act as your own trustee, plan administrator, so you have direct control without any intermediary. Within the IRA space, in order to get to crypto, you do have to pass through a custodian. IRAs must have a custodian, but the custodians have to act in a administrative role. They're passive. They do their annual reporting to the IRS, but you have total control of the investment. We have a structure that we set up that actually makes it very cost effective, and it takes the control of the asset away from the custodian, and it puts it directly in your hands, so you can open up accounts on any exchange or purchase real estate wherever you'd like without incurring transactional fees.
We've got about a minute left. What about these self-directed checkbook control retirement accounts?
Yes, so that is actually a key focus of ours. And in order to get into crypto in the most efficient way, you actually need the checkbook control structure. The checkbook control structure, at this point has a lot of history behind it. There are rules, compliance rules that investors must be aware of. The key thing is to recognize that whatever is in the IRA is there for the IRA and not for your own personal needs. That's got to remain completely segregated and tracked. Any assets have to be titled in the name of the IRA or any LLC that's within the IRA in order to keep that apart from your own funds. But the checkbook control structure is actually the key to cost-efficient and effective and flexible crypto or real estate tax-free investing.
Good information. All right, Bernard, we've got to run. It's the end of our segment. To reach out to you, it's 401checkbook.com. Is that correct?
401kcheckbook.com.
Got it. All right, Bernard Reisz, financial expert in ReSure Financial. I want to thank you for being on the show. The show's been brought to you today by Tycon Partners. You've been listening to CEO Money with Michael Yorba and Ed Baxter.